I think actually what I'm suggesting, a very high percentage of people should do something like that. So I think it's a policy that'll get a good result and is likely to stick. I recognize the logic of the fact S&P algorithm is very hard to beat. It's all but impossible for most people.
In 2013, Warren Buffett's letter to shareholders revealed something interesting and personal. It even shocked a majority of investment managers and retirement planners. The investing legend wrote that the trustee of his wife's inheritance had been instructed to put 90% of her money in a very low-fee stock index. He recommended short-term government bonds for investing the remaining 10%. This is the classic 90-10 bond equity portfolio suggested by Warren Buffett, and the 90% equity component goes to index funds. So you must be thinking about why this legendary investor is so convinced about a low-cost index fund. Well, in this video, we're going to talk about 4 things. Number 1, why Buffett thinks S&P 500 index funds are a great choice for the majority of investors. Number 2, how can one practically implement his advice? Number 3, the best S&P 500 index funds. And number 4, the concept of dollar cost investing. Starting with reason number 1, you don't need any special skills. Anybody can do it. This time-tested investing thumb rule doesn't require any specialized knowledge or skill in portfolio management. You just need to invest in any low-cost S&P 500 index fund of your choice and hold as long as you can. If we look at the number, since its inception in 1957, the S&P 500 has generated an average annual return of about 10%. That's not at all bad. Even though the journey had its hiccups, the ones with patience won in the long run. Just to give you a context, at a 10% annualized return, investing $150 on a weekly basis can be worth $1 million in 28 years. Don't worry about the periodic ups and downs of the market. Don't panic when the market falls by 30 or even 50%. Just hold tight and keep invested for the long term. Also, remember one of Buffett's most quoted advice: be fearful when others are greedy, and greedy when others are fearful. Reason number 2, passive investing beats active investing in the long run. In a passive investing, you don't actively buy and sell stocks aggressively and frequently to beat the market. Instead, you follow a simple investing principle or rule of thumb and stick to it in the long run. Investing in an index fund is probably the most profitable passive investing technique, especially for common investors. Buffett advises, keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Also, the good news is that we have plenty of evidence to suggest passive investing performs better than active investing in the long run. For example, the S&P Indices versus Active Funds, or SPIVA Europe scorecard, shows 95% of active funds failed to beat the U.S. equity benchmark. Moreover, 96% of active funds failed to beat the global equity benchmark. Warren Buffett's conviction on index funds is so strong that in 2008, he placed a $1 million bet against leading hedge fund managers. And, as he guessed it right, after around a decade, Buffett came out as the winner. The S&P 500 gained as much as 125.8% between 2008 and 2017. In comparison, an average active fund generated about 36.3%, less than 1/3. Want to know more about this interesting story? Let us know in the comments. Reason number 3, it's impossible to pick the perfect stocks. Even though the S&P 500 gives you an average annual return of 10%, a lion's share of this growth comes from a small number of stocks. In fact, a large number of stocks generate negative returns over a period of time. This means it's a loser's game to try to pick the perfect stocks. In 2017, economist Hendrik Bessembinder published a paper called "Do Stocks Outperform Treasury Bills?" The study reveals that only the best performing 4% of listed stocks explain the net gain for the entire U.S. stock market since 1926. For the other stocks, they just collectively match the return of Treasury bills. What this essentially means for you is investing in a broad-based index increases your chance of creating wealth in the stock market. For the non-professional investors, who are the majority, Buffett's advice is own a cross-section of businesses that, in the aggregate, are bound to do well. Reason number 4, index funds have a huge cost advantage. Actively managed funds involve higher transaction costs and fees. All those frequent buying and selling of stocks and rejigging of portfolios can increase transaction costs significantly. In Buffett's own words, costs skyrocket when large annual fees, large performance fees, and active trading costs are all added to the active investor's equation. He also added, investors, on average and over time, will do better with a low-cost index fund than with a group of funds. Again, we have no dearth of data to support these claims. The Standard & Poor's mid-year 2022 report says, adjusting for fees, in 5 years, about 84% of large-cap actively managed fund managers underperform the benchmark. And after 10 years, 90% of them underperform. Reason number 5, you can avoid a lot of investing mistakes by sticking to index funds. In his 2014 letter to shareholders, Warren Buffett writes, active trading attempts to quote-unquote time market movements, inadequate diversification, the payment of high and unnecessary fees to managers and advisors, and the use of borrowed money can destroy the decent returns that a lifelong owner of equities would otherwise enjoy. What this investment legend essentially means is that active trading can lead to a number of investing mistakes and pitfalls. A lot of potential wealth is lost in a bid to time the market movements, or because of frequent buying and selling of stocks. On the contrary, investing in an index fund is pretty straightforward. It reduces your market activities and the chances of errors. The short answer is that you can simply invest in an S&P 500 index fund. For this, Warren Buffett has often suggested the Vanguard Index Fund. In addition to the Vanguard 500 Index Fund Admiral shares, ticker symbol VFIAX, 2 leading S&P 500 index funds are Fidelity 500 Index Fund, or FXAIX, and Schwab S&P 500 Index Fund, or SWPPX. But note that I'm not a financial advisor and I'm not recommending any of these funds. Please do your own due diligence. Now, remember that all these funds track the same underlying assets, which are the components of the S&P 500. So an important evaluation criterion is the cost ratio of the fund. The cost ratio, also called the expense ratio, shows the percentage of a fund's assets spent on operating and administration expenses. So let's look at the cost ratio of these leading S&P 500 index funds. At the time of recording, the Vanguard 500 Index Fund Admiral shares has a cost ratio of 0.04%, and it has provided a 10-year annualized return of 12.82%. Whereas the Fidelity 500 Index Fund has a cost ratio of 0.015% and has provided a 10-year annualized return of 12.85%. Lastly, the Schwab S&P 500 Index Fund has a cost ratio of 0.02%, and it has generated a 10-year annualized return of 12.80%. When comparing funds that track the same index or have similar strategies, as a general rule of thumb, a lower expense ratio can be a crucial factor to consider. Over time, even small differences in fees can have a significant impact on your returns. Now, what if you don't have access to the S&P 500? Well, in that case, you can simply invest in a broad index fund having a good number of stocks. For example, you can consider the MSCI World ETF, which includes stocks from 23 developed countries. The concept of dollar cost averaging will help you automate your investments in index funds. Dollar cost averaging simply means you need to invest the same amount of money in the same security at a fixed interval. For example, you can simply invest $100 every week or $500 every month in an index ETF, no matter whether the market is up or down. This will optimize your cost of investment. Also, you will be able to steer clear of the temptation to time the market. Going by Buffett's advice, if you follow dollar cost averaging on an index fund, you are likely to do much better than a majority of active investors. And it has been proven time and again. And that's our financial deep dive for today. Remember, every penny counts, and so does your feedback. So drop your thoughts down below, and we'll see you in the next video. Bye for now.
This is gonna blow your mind. Subscribing could change the way you watch YouTube forever. Seriously, don't miss out. One click makes all the difference. Subscribing and smashing that like button isn't just for show. It tells YouTube you actually want to see more of my videos. If you skip it, you might never see my content again. So don't let FOMO get you. Hit subscribe, like this video, and let's make sure you're always in the loop. Trust me, you won't want to miss what's coming next.